Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
If you are just joining us, here are the numbers for you. 175 is the number. The estimate was 240. That's the headline payrolls print. Looking at unemployment, it comes in at 3.9%. Previous number 3.8, the estimate 3.8. And wage growth month over month, 0.2%. The estimate 0.3. To react, here's the lineup. Mohamed, El-Erian of Queen's College, Cambridge, alongside BlackRock's Jeff Rosenberg. Mohamed, first to you, your reaction to this one.
You said it, John. A Goldilocks report that will please the Fed and please the markets. I'm not particularly surprised on the miss on job creation because we've been running at very high levels for the year and a monthly average of 251,000 before this one. I'm a little bit surprised on the wage, the 0.2. That's the one that surprises me. But overall, it is a Goldilocks report.
Mohamed, at first look, how would you explain that? How would you explain this continued strength in payrolls growth and this little weakness, touch of weakness, softness in wages?
I know how it will be explained. It will be explained by new entrants into the labor force at much lower level, at a much lower level. I'm just surprised it has made that much of an impact. So that's something that one needs to look at much more closely.
Jeff Rosenberg, I'd love your take on this because right now the market is celebrating. Are you celebrating also? Do you think this is a reason to buy, or do you view this as basically a lot of noise for people who are just looking for any direction at all?
Well, I think Jonathan said it. This couldn't have been scripted better. This report runs the tables for a good report. This is bad news. A little bit is good news, but it's really just about, how bearish we got. Jonathan mentioned it, ECI, the rate moves, the expectations in front of Wednesday's FOMC. So some of this is just positioning. You had a lot of bearishness, so people put shorts on. There was a big momentum to higher rates. But this is a good report across the board for validating what we heard from Jay Powell on Wednesday, that kind of what me worry about inflation, no, things are going to slow, don't get overexcited. And I think it's a little bit of that overexcitement on the short side that's being wrung out of the markets right now.
Mohamed, does it concern you that we saw the unemployment rate tick up to 3.9%, the sort of incremental shift up about a half a percentage point from some of the recent lows?
Does it concern me? Yes, because people are losing their jobs. But let's not forget, we've had 27 straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No. But if the increase accelerates, that would really worry me. Remember, especially at the low income side, wage are key to consumption and key to economic growth. Pandemic savings have been run down, credit card balances have been run up. So wage income is absolutely critical to the well-being of this economy. So 3.9% is still a really good unemployment rate, but I wouldn't want to see it get close to 4.5% anytime soon.
This softer print, though, that we're seeing and digesting right now, Mohamed, is this enough for potentially people to start talking about cuts this summer?
Oh, I suspect that what was pushed back to December got pushed, I don't know which way we go. Anyway, got pushed forward to November before this, and after Chair Powell, this will take us to September. There is a bigger issue, and others can speak to it much better than I can, including Jeff, is this volatility that we're seeing in the interest rate structure. It is causing havoc elsewhere in the world when U.S. rates swing as much as they do on a short-term basis. So this volatility, which we are continuing to see in rates, risks I'm afraid, risks breaking something elsewhere, and that's what we got to keep an eye on.
Well, let's get into that. So the next stop for this conversation, for anyone who wants the calendar, May 15th is when we get the CPI report, so this can all change once again, as you all know. Jeff, let's talk about that. How much expectations have swinged? How much the narrative has changed? I remember a conversation we had with Aberdeen, James Athey. He called it narrative table tennis, narrative ping pong, just back and forth, back and forth. We've gone from 7 cuts to 1. Arguably, by the end of today, we'll be talking about 2 again because of this jobs print. Jeff, what do you make of that? Just how quickly we've gone from one direction to the other in rate pricing?
Well, it's because the Fed has abandoned forecast-based monetary policy, right? We basically have had a very bad experience with trying to forecast inflation. So we've abandoned forecasts and we react to the data. And we're reacting to the data because the Fed reacts to the data, and that's basically what they tell us to do. And it's very hard print to print to know where that data is going. We've had serial degrees of surprises, and we're continuing to see those surprises. And so that's why there's this heightened degree of volatility, because the Fed is basically no longer willing to provide a forecast, to stick with its forecast, to give the market a clear trajectory. And so we're really forced to react and change those expectations for timing, December, November, September, July, based on every other data, every single data point.
Mohamed, you've said this a million times. Every time we've spoken on Payrolls Friday, the lack of a strategic anchoring at the Federal Reserve contributing to this whipsawing that we've seen in rate pricing on every single data point. You've talked about them being hypersensitive to incoming information. In the Financial Times, I saw your recent article. Chair Powell's dovishness is right, not for the reasons that he believes. Can you talk to us a little bit more about that, Mohamed?
Yeah, and I want to thank Jeff. I wanted to reach out and hug him through my computer, because he just said what I've been saying, which is rather than provide a strategic anchor to markets, the Fed got on the roller coaster of reacting to high-frequency data. And therefore, we have a very reactive Fed. And what does that do? It amplifies the volatility in the market. So there is a concern that the Fed is overly data-dependent. I think that overly data-dependent stance is what may end up leading us into a Fed policy mistake. I hope we don't get there. And that's why a strategic view is necessary. And I suspect if you were to take a strategic view, you would not have validated the market's overreaction from going from 7 cuts all the way to 1, where some people even say you're going to get a hike. You would have said, no, this economy is slowing. It's slowing in a gradual fashion. Let's not push it into something more dramatic. And you would stick to your 2 to 3 cuts this year. But this Fed is data dependent, John, so I don't know where they're going to end up.
Jeff, what's your take on that, this idea that the fluctuations in and of themselves, sort of whipsaw action and whipsawed narratives in markets, is actually creating a potential headwind to how this all plays out and potentially to the Fed actually achieving their soft landing?
Well, I mean, it is a headwinds, but we also have to see the other side of this, that the equity market has been, much more resilient to these shifts in the interest rate narrative. And when you think about financial conditions and the transmission of market volatility into the real economy, it's mostly going to happen from the equity side. Not to say that interest rates and credit spreads don't matter, but we're talking about volatility around elevated rates of base rates of borrowing in an environment of very muted and compressed credit spreads. So the marginal financial condition easing and tightening, it's coming from the equity side. And there the story has been much more about the numerator, much more about the secular growers, the tech story, the incredible earnings that we're seeing. And as long as the rate picture stays bounded, unlike what we had over the last 2 years with these huge swings from Fed policy, inflation uncertainty, I think you can mitigate some of that transmission of the volatility that we're talking about as a result of the Fed's policy shift from forecast to data dependence into the real economy, because you're not really seeing it transmitted through the equity market.
But Jeff, do you think that there is sort of a challenge to the broadening out trade? To Mohamed's point, that this actually could cause something to break outside of the United States at a time when a lot of people are saying the U.S. is no longer so exceptional, the rest of the world is catching up. Does this challenge that?
I mean, there are certainly challenges. You know, Jonathan highlighted the yen reaction, the FX component of interest rate divergences. You always have those degrees. I think what we've seen, though, is a remarkable degree of resiliency in the global economy. You know, I think we talked on Wednesday about the differences in emerging market sensitivity to Fed policy this time round. Really much more about a function of the change and the more traditional policy approach happening in emerging market central banks, much more credible policy, dampening some of that pass-through. So I think you have certainly the core interest rate volatility. You know, you look at the MOVE index, it was once at 50, now it's between 100, 150, 200, much higher degree of interest rate volatility. And that has its problems, as Mohamed laid out. I think we're seeing a little bit less pass-through, though, in some of these more traditional areas, and that can kind of mitigate some of this concern about the effect of the policy uncertainty from data dependence into the real economy. Not taking away what Mohamed said, though, I agree with his point, that you still have the potential there for a policy mistake as a result of no longer anchoring to forecast-based policy.
Let's reach for dollar yen. Let's talk about that move, not just on the session, but talk about it on the week. It's been phenomenal. Moments ago, we had a 151 handle on dollar yen. Right now, just about holding on to 152 at 152.24. On the week, it's about 4 percentage points of yen strength. But go from the highs of Monday. Monday, 160.17. From those highs to where we are, you've seen a move of more than 5 percentage points. Yen strength big time. I've mentioned the time in Tokyo repeatedly. It's 9:44 p.m. going into the weekend in Tokyo. Raise a glass. Sort of, you know, walk away feeling pretty good going into the weekend, Bramo, because that's the stronger Japanese yen the Japanese authorities wanted.
They could either walk away or they could lean in, do a little more intervention now when they're in a holiday and you're actually getting a tailwind from the U.S. economic data. And oh yeah, you want to be short us? You want to be speculative? Good luck.
Mohamed, I don't know if this move sticks, but I'm sure they want it to. How happy do you think authorities are abroad after this number?
So certainly the Japanese authorities are very happy. Between Chair Powell's more dovish than expected press conference and today's number, a lot of the pressure has been relieved. And like you say, we were at 160 on Monday, and we are at 160 risking another disorderly move. I suspect that around the world, people will feel some relief. You have emerging market economies that need to cut interest rates from a domestic side, but are afraid of the consequences for their currency. Yes, Jeff is right. They've been resilient so far, but the degree of resilience has come down a lot. So we shouldn't test them too much. You have the ECB that wants to diverge from, for good reasons, they want to diverge from the Fed and keeps on telling us we're not Fed dependent, but knows in the back of its mind that there's a limit. You know, for the rest of the world, it's about the movement in the U.S. Yield curve. It's about what U.S. rates are doing. For the U.S. economy, I agree with Jeff. It's about the equity market. But for the rest of the world, because of exchange rates, it's about what U.S. yields do.
Well, let's sit on the rest of the world, Mohamed, just for a beat. So the conversation's been dominated, as you know, over the last month with words like exceptionalism. You've written about it. Divergence. There will be some people getting excited about the prospect of convergence, that this was peak exceptionalism when we're moving on beyond that, that maybe we've seen the peak in the US dollar, a peak in US yields. Do you think those conversations this morning, Mohamed, after one jobs print, are a little bit too premature?
Totally too premature. There's three elements to this exceptional US behavior. One is its growth performance. Two is the manner in which it's investing in the future. And three, it's its ability to get away with a fiscal stance that other countries cannot get away with. In order to get convergence, you would need convergence on all three. And we're not going to get convergence on all three. U.S. is going to remain exceptional. Its growth performance may not outpace others as much as it has, but it is the only major economy in the West that is seriously investing in tomorrow's engines of growth. And because of the role of the dollar, it can run an irresponsible fiscal policy for much longer than others can.
They retain the privilege of acting recklessly, maybe for a little bit longer. Pierre, Ferragu of New Street Research has a neutral rating and a 175 price target on shares of Apple. He joins us now for more. Pierre, I want to go straight to sales, and then we'll get to financial engineering. Do you think the sales declines are behind us?
Yes, I think we are progressively reaching like a trough and a stabilization. It doesn't look like we're going to see like a major correction in sales. So I would say yes, the decline is behind us, things are stabilizing, but we're not going to have like a significant rebound from where we are today.
Well, that's what I want to get into. So JP Morgan are talking about a launch pad into the AI upgrade cycle. How much of a launch pad do you see in September?
Yes, I'd be very, very careful about that. If you look at what people tell me around on, the silicon of the iPhone, it doesn't look like this September product cycle is going to be a cycle where generative AI is like a revolution in terms of hardware. And if it's not a revolution in terms of hardware, can it be really like a revolution in terms of features and drive really like an upgrade cycle? So I've heard this argument a lot. People are asking more and more whether we could get into a very nice product cycle. I think it's too early to say, and I think it wouldn't be prudent to be overly optimistic. Generative AI is still in the making, and how you get that into an iPhone and create like a wow factor that really gets people, like gets really the word out and people willing to accelerate the replacement of their phone. I'd need to be convinced. And see what the future would look like.
Pierre, we're not convinced what's going on in China either. There seems to be a disconnect here between the guidance that we're getting from the company, what they're telling us is happening on the ground, and what independent researchers are seeing as well. What explains that spread, that distance between the company and independent researchers?
It's very surprising. It's a major surprise. We didn't see that coming at all. We were clearly expecting Apple to create like a much lower point in China. So unfortunately, I don't have an explanation for you, John. It's like it's something we'll have to better understand. In the next few days, we're going to try and circle back with independent research providers to understand in their methodology what they could have been missing or how the disconnect could be explained. So what we see is like Chinese players coming back into the market, coming back into the higher end of the market, putting at risk, the 20 million odd like units iPhone won over the last 3-4 years out of a lack of competition in China. This is not materializing. So does that mean this Chinese phone went into the channels, did well in early weeks, but actually didn't convince consumers? That would be one explanation, but we need more research to figure that out. As I said, a very, very strong surprise, very, very significant surprise.
Yeah, and to build on that, the CFO of Apple saying the reality is different from maybe what you read at times about what we see in China. This raises a question of how much Apple either needs to address Xi Jinping diplomacy and kind of what the line is from authorities in terms of discouraging or encouraging people or allowing them to buy iPhones going forward in the region, or whether it really even matters. In other words, how much do you have to have clarity on this to still have faith in the stock?
Well, because things have stabilized and normalized, over a couple of years, you don't really have growth in iPhones. The positive aspect of it is that it doesn't create that much of a downside risk, but also not that much of an upside risk. So I think the iPhone is like mostly like a de-risk standpoint. And so the only thing that could really create a surprise from here on the iPhone is like a significant product cycle. And of course, if that happens, it would have to be related to generative AI. That's like the new features the company is working on. So that's really where we stand. Not much is going to happen on the iPhone front until we see this product cycle. And my point is, like, building conviction on the product cycle for this September is probably too early. You don't have enough evidence of that coming.
Is this still a growth stock, or is this a value stock delivering buybacks that count for basically more than the value of both Ford and GM put together?
That's a good question. I would say I would struggle to call it a growth stock, but it's still a compounding stock. If you add up, the kind of like still excellent pricing power the franchise has, which means that prices can go in the right direction in low single digit every year. the growth potential in services and the excellent financial performance that translates into very good buybacks, it's still like a story that can compound earnings and free cash flow in mid to high single digits. So that's a good compounder. And of course, the quality of the stock is reflected in the price. It's trading at a 50% premium over S&P names that have the same kind of growth potential, growth outlook. So it's an expensive single-digit compounder, I would say. And that's the reason why we're very neutral on this stock. We don't see major issues with where valuation or where expectations are. It's just that it compounds slowly.
Pierre, services was a relative bright spot for Apple, but they're obviously dealing with a lot of regulation around the world. Is there a ceiling on how much they could bring in from services?
Yeah, a ceiling is actually the right way to think about it, more than downside risk. So Apple has a lot of pressure. So you can't imagine like an aggressive move with an aggressive pricing and monetization strategy coming through in that environment. Now, what you see over the last 2-3 years is that the regulatory pressure, like the general, like I would say, public opinion pressure that Apple has on, like the very comfortable monetization they can exercise on the App Store, basically means that the take rate is eroding very slowly over time. But like now, like the risk of a major clampdown appears very, very remote. So services overall growing, in low teens with, revenues from Google for licensing continuing to grow, the App Store continuing to grow, even if the tech rate is coming down, the volume on the App Store is still growing, and then Apple's in-house subscriptions. All these things are like nice, healthy, I would say, low teens growers. And like a reacceleration from these levels is very unlikely, but that growth is still very high quality.
Hey Pierre, you're one of the best. It's good to hear from you. Pierre Ferragu there of New Street.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.